Oil is spiking, stocks are tanking, crypto just got liquidated to the tune of $500 million. And as you are watching this video right now, the United States of America has officially launched major combat operations against Iran. This is not a drill, this is not a simulation. This happened today. And if you have money in the stock market, in crypto, in real estate, or even just sitting in a savings account, what happens in the next 72 hours could change your financial life. Stay with me because this is the most important financial breakdown you will watch this week. All right, let's slow down and make sure we're all on the same page because this story has been building for a long time and it exploded today in a way that even seasoned market veterans didn't fully anticipate. Here is a quick timeline you need to understand. Back in June 2025, Israel launched a surprise military strike on Iranian nuclear facilities. That was the opening shot. Markets reacted. The S&P 500 dropped over 1%, oil surged 7% overnight, gold rallied, and the VIX, that's Wall Street's official fear gauge, spiked above the critical level of 20. Panic flooded trading floors from Tokyo to New York. But here's the thing, markets recovered relatively quickly after that June strike. Why? Because the conflict, while dramatic, stayed somewhat contained. Iran retaliated with missiles and drones, there were casualties, there was damage, but crucially, Iran did not attempt to close off the Strait of Hormuz. That one detail kept global markets from full meltdown mode. Fast forward to today, February 28, 2026, the situation has exploded into something far more serious. President Donald Trump announced that the U.S. military has launched what he called major combat operations against Iran. Multiple ministries in the southern part of Iran's capital, Tehran, were targeted. We are no longer talking about Israel acting alone. The world's largest military superpower is now directly in this fight. And markets are bracing. Economists at major institutions like Natixis are projecting global equities could open down 1 to 2% or more. Oil is expected to jump anywhere from 5 to 10%. U.S. Treasury yields are expected to fall, that's the classic flight to safety, and gold, the U.S. dollar, and the Japanese yen are all expected to surge. So the question every investor, every trader, every person with a retirement account needs to be asking right now is this: how bad can this get, and what do I do about it? I want to spend some real time here because this is the single most important piece of geography on the planet right now from a financial perspective, and most people don't fully understand it. The Strait of Hormuz is a narrow strip of water, we're talking about 33 miles wide at its narrowest point, that separates Iran from the Gulf states of Oman and the UAE. It connects the Persian Gulf to the Arabian Sea and then to the rest of the world's oceans. Now here's why you should care deeply about this. Roughly 1/3 of all the world's seaborne oil passes through this strait every single day. That's approximately 21 million barrels of crude oil flowing through that narrow passage every single day. Countries like Japan, South Korea, China, and India are almost entirely dependent on oil that moves through the Strait of Hormuz. Europe gets significant amounts of LNG, that's liquefied natural gas, from this corridor. Even with America's domestic energy production, a disruption here sends shockwaves through every single economy on Earth. Because energy is the foundation of everything. It powers factories, it fuels trucks that deliver your groceries, it heats your home, it runs the data centers that power the internet. Now, Iran has long held this over the world's head like a trump card. Their military has the capability to mine the strait, to deploy submarines, to launch missiles at oil tankers. Closing or even partially disrupting the Strait of Hormuz would be the financial equivalent of pulling the power cord out of the global economy. As of right now, the strait has not been closed. That is the critical detail markets are watching like a hawk. David Roach of Quantum Strategy put it plainly: if this conflict stays short and contained, the oil spike will be brief. But if this turns into a 3 to 5 week campaign aimed at regime change, markets will react, in his words, rather badly. So every morning when you wake up and check the news this week, the first thing you should be looking for is, has Iran made any move toward the Strait of Hormuz? because that single decision could be the difference between a painful but manageable market correction and a full-blown global economic crisis. Let me walk you through exactly how a spike in oil prices cascades through the global financial system, because this is the chain reaction that every serious investor is modeling right now. It starts with crude oil. The moment conflict escalates in the Middle East and supply is threatened, oil prices spike. We've already seen this happen. Brent crude, the global benchmark, jumped nearly 9% in one day after Israel's first strikes in June 2025. Experts are now projecting a 5 to 10% jump just from today's US strikes alone, and that's assuming no major escalation. When oil prices go up, everything goes up. Gasoline, diesel, jet fuel, plastics, chemicals, they all come from oil. This means the cost of manufacturing goes up, the cost of shipping goods goes up, the cost of flying goes up. Airlines are particularly exposed. We saw Delta and United fall 4 to 5% in a single day during the June 2025 episode. Now, here's where it gets really complex. When energy prices rise sharply, inflation goes up. And when inflation goes up, central banks, especially the US Federal Reserve, are forced to either raise interest rates or delay cutting them. Think about what that means. The Fed has been on a rate-cutting cycle. Lower interest rates mean cheaper mortgages, cheaper business loans, more money flowing into stocks and real estate. Investors love low interest rates because money is cheap and easy. But if oil-driven inflation forces the Fed to pause or even reverse course, suddenly borrowing becomes more expensive. Corporate earnings projections get revised downward, and stock valuations, which are built on assumptions about future interest rates, have to be recalculated. JP Morgan's research team has been clear. If oil breaks above $100 per barrel, which happened during Russia's Ukraine invasion, the inflationary pressure becomes severe enough to derail growth in most major economies. For reference, during that conflict, oil hit above $100 a barrel. We're currently sitting around $70 to $77. If this conflict escalates sharply, those $100 projections come back onto the table very fast. And what about Asia? Countries like Japan, South Korea, China, and India are uniquely vulnerable because they import almost all of their oil. A sharp oil price spike is essentially a massive tax on their entire economies. Growth slows, trade balances deteriorate, and their currencies can weaken, which creates its own set of inflationary pressures. Let's get into the specifics of what markets are actually doing right now, because this is where the rubber meets the road. First, let's talk equities, that's stocks. The pattern we're seeing today follows what market veterans call a risk-off trade. When fear enters markets, investors sell what's risky and buy what's safe. Expect global equities to open lower. We're talking potential drops of 1 to 2% at minimum in US indices, the S&P 500, the Nasdaq, the Dow Jones. European and Asian markets will likely mirror this. This is what we saw in June 2025, and today's situation is more serious because the US is directly involved. Sectors that get hurt in this environment, airlines and travel, fuel costs are their biggest expense, consumer discretionary stocks, people spend less when energy bills go up, emerging market stocks, foreign investors flee to safer, developed markets, technology stocks can also get hit because the risk-off trade drains liquidity from growth stocks. Sectors that benefit, energy companies, Exxon, Chevron, BP, Shell, they make more money when oil is expensive. Defense contractors, Lockheed Martin, Raytheon, Northrop Grumman, conflict means government contracts. Cybersecurity companies, wars now have digital dimensions and nation-states amp up cyber attacks, and gold mining companies, because when gold goes up, so do their profits. Speaking of gold, gold is the ultimate safe haven asset. In times of geopolitical crisis, investors worldwide pile into gold because it holds value when everything else is uncertain. We saw this in June 2025, we saw it in Russia, Ukraine, and we're seeing it again right now. Then there's crypto. Bitcoin, Ethereum, Solana all dropped sharply. Bitcoin fell over 3% in just an hour after the news broke. Ethereum followed, Solana dropped 4%. Total liquidations across crypto markets hit over $500 million in just 24 hours. Crypto, despite what some call it, is not a safe haven in moments of acute crisis. It behaves more like a high-risk tech stock. When fear spikes, it sells off hard and fast. In currencies, the US dollar, the Japanese yen, and the Swiss franc are all expected to strengthen. These are the world's traditional safe haven currencies. Meanwhile, currencies of commodity importing nations, the South Korean won, the Indian rupee, the Turkish lira, are all under pressure. Treasury bonds, specifically US government bonds, are getting a bid as well. When investors get scared, they buy treasuries because the US government is considered the safest borrower in the world. When bond prices rise, yields fall. And yes, that creates its own strange dynamic because lower yields mean the Fed may have more room to cut rates, but only if inflation doesn't spike from oil. Here's where I want to give you some important perspective because it's very easy to panic right now, and panic is almost always the wrong financial decision. History tells a remarkably consistent story about geopolitical crises and markets. In 1990, Saddam Hussein invaded Kuwait. The market dropped, oil spiked, investors panicked. But within months, after Desert Storm resolved quickly, markets recovered fully and went on to boom through the 1990s. In 2003, the US invaded Iraq. Markets initially fell. Then they recovered and ran for years. In 2006, Israel and Hezbollah fought a brutal war in Lebanon. Markets barely blinked. In 2024, Israel and Iran exchanged direct strikes for the first time in history. Markets dipped briefly, then rebounded. The consistent pattern is this. Short, contained regional conflicts have historically had a short-lived impact on markets. The initial shock creates a buying opportunity for disciplined investors. JP Morgan's data shows that a diversified stock-bond portfolio tends to outperform cash on both a 1-year and 3-year basis after geopolitical crises. But, and this is a big but, the Russia-Ukraine war in 2022 was different. Why? Because it combined geopolitical shock with already existing supply chain disruptions from COVID, runaway inflation, and a Federal Reserve that had to rapidly hike interest rates. The cocktail of multiple simultaneous problems is what caused the bear market. And here's why some analysts think this situation could also be different. We are not starting from a clean slate. The global economy is already dealing with Trump's tariffs, a 15% tariff on all US imports announced recently. That alone is inflationary. Now layer on top of that an oil price spike from a Middle East war involving the United States directly. You've got two major inflationary forces hitting at the same time. The Fed's rate-cutting plans could get derailed entirely. And that combination, tariff inflation plus oil inflation, is the scenario that serious economists are quietly very worried about. The key question the market is still trying to answer is this a short precision campaign, or is this the beginning of a sustained multi-week war aimed at regime change in Iran? The answer to that question will determine whether this is a buying opportunity or the start of something more painful. To truly understand the financial implications, you need to understand the geopolitical chessboard, because markets are not just reacting to what's happening today, they're pricing in what might happen next. Iran's response is the most critical unknown. If Iran responds by targeting US military assets in the region, we're talking bases in Qatar, Bahrain, or Iraq, the conflict escalates sharply. Markets would react very badly. If Iran responds by proxy, using Houthi forces in Yemen to attack shipping in the Red Sea, or using Hezbollah to launch attacks on Israel from Lebanon, that's a broader but still indirect escalation. And the worst-case scenario that markets are quietly pricing in as a tail risk, Iran attempts to close or disrupt the Strait of Hormuz. This is their ultimate economic weapon. The disruption to global oil supply would be immediate and catastrophic. Then there are the second-order geopolitical effects. China has close economic ties with Iran. How does Beijing respond? Does Russia use this moment of US military engagement elsewhere to press advantages in Europe? How do Gulf states like Saudi Arabia and the UAE, which sit between Iran and the global oil market, position themselves? From an investment standpoint, Allianz Global Investors and other major institutions are also pointing to maritime trade routes as a serious ongoing risk. The Red Sea was already disrupted by Houthi attacks in 2024 and 2025. Ships were already being rerouted around the Cape of Good Hope, adding weeks and significant cost to shipping. If the Strait of Hormuz becomes unsafe, there is literally no alternative route for that oil. It cannot be rerouted. That makes it categorically more dangerous than the Red Sea disruption. Insurance costs for shipping in the region are already climbing. Shipping insurance is a quiet but leading indicator. When Lloyd's of London and other insurers start pricing in war risk premiums on tankers, it's a signal that real money is betting on continued and worsening conflict. And then there's the nuclear dimension. Iran's nuclear program was the original trigger for Israel's strikes in June 2025. One of the key unknowns is how close Iran actually got to a nuclear weapon before those strikes. If Iran retains significant nuclear capability, or if the strikes accelerated their resolve to build one, the long-term geopolitical risk premium in markets doesn't go away. It becomes permanent, and permanent risk premiums suppress investment and economic growth over years and decades. All right, let's talk about what this means for you, practically, financially, right now.
First and most important, do not panic sell. I cannot stress this enough. Every major geopolitical crisis in modern history has eventually resolved. Markets have recovered from all of them. Panic selling locks in losses and means you'll miss the recovery. History is unambiguous on this point. Second, review your energy exposure. If you don't own any energy stocks, companies like ExxonMobil, Chevron, BP, or energy ETFs, now is a moment to consider your allocation. Energy is the sector that almost always benefits in this environment. I'm not telling you to chase performance, I'm telling you to evaluate whether your portfolio has the kind of diversification that protects you when oil spikes. Third, gold deserves a look. Gold has been performing well in 2025 and 2026, even before this escalation. As a portfolio hedge against geopolitical chaos, gold has thousands of years of track record. Whether that's physical gold, gold ETFs like GLD, or gold mining stocks, this is a legitimate defensive position right now. Fourth, be very cautious with crypto during this period. Crypto is behaving like a high-risk asset in this environment, exactly the kind of thing professional money managers are selling right now, not buying. If you have significant crypto exposure, understand that you're in a high volatility position during a high uncertainty moment. Fifth, keep some dry powder. That means cash. Major institutional investors are actually positioning with cash reserves right now because they don't know which direction this goes. If markets fall further, having cash means you have buying power. Some of the greatest investment opportunities in history have come in the immediate aftermath of geopolitical crises. Sixth, and this is the sophisticated move, watch the Strait of Hormuz like a hawk. If Iran makes any move toward that strait, you want to know immediately. That's your signal that the risk calculus has changed dramatically and more defensive positioning is warranted. And finally, think about geographic diversification in your portfolio. This conflict makes U.S.-heavy portfolios look more risky, not less, because the U.S. is now directly in this war, and U.S. assets are priced at historically high valuations. European and select Asian markets that aren't directly in the conflict zone may offer better risk-adjusted returns in this environment. Here's the bottom line. Today, February 28, 2026, the United States launched major combat operations against Iran. This is a historic moment with serious financial consequences. Oil markets, stock markets, currency markets, bond markets, and crypto markets are all moving in real time in response. The honest truth is nobody, not Goldman Sachs, not JP Morgan, not the Federal Reserve, nobody knows exactly how this ends or how bad it gets. What we do know is this: markets hate uncertainty. And right now, uncertainty is at a level we haven't seen since the early days of Russia's Ukraine invasion. But history also tells us that disciplined investors who stay calm, stay diversified, and think long-term consistently outperformed those who panic. The investors who made money in every previous crisis were the ones who prepared before the crisis hit and who used the volatility to buy great assets at lower prices. So educate yourself, watch the Strait of Hormuz, watch oil prices, watch the Fed, review your portfolio, talk to a financial advisor, and whatever you do, don't let fear make your financial decisions for you. If this video helped you understand what's happening and what it means for your money, please like and subscribe. Drop your questions in the comments. I'll be doing a follow-up video as this situation develops. And share this with anyone you know who has money in the markets and needs to understand what is happening right now. Stay smart, stay calm, and I'll see you in the next one.